Please visit tradingsim.com to simulate this trading lesson. Hey day traders, this is Al Hill from tradingsim.com. I'm going to talk about another Richard Wyckoff trendline example today. So let's zoom out a little bit here. We're looking at Jazzo on a 5-minute chart from July the 2nd, 2010. And be really brief about this, right? So again, Richard Wyckoff does not call for, trend lines, here and here and, down this way. It's very basic, right? You just have parallel trend lines with equal amount of distance between them so that the price action can just kind of float inside of those lines. You're not looking for these very cumbersome formations. So in this example, you see the stock Jazzo gap down and started a trend range, right, or a range here. Now some traders would come across here, like I said earlier, try to make some connections here, make the argument that this is kind of stair-stepping, right, on this trend line. Wyckoff doesn't subscribe to that, because then you could get into this kind of thing here where you're doing this, and now you're saying, oh, this is a megaphone, and Wyckoff just felt that this just adds to the confusion of the market, right? That's already confusing enough. So what you want to do here is simply create a horizontal trend line across the top of the resistance here. This is your supply line, or where folks will want to come in and start selling. And then you want to create a demand line, or your buy line, which is where folks will want to start buying. That's it. There are your lines. Straighten it up a little bit. There are your lines. And when you look at it like that, it does simplify the market quite a bit. So in this example, Jazzo came down on some heavy volume relative to the previous candlesticks, and you see that the sellers were trying to bust, or shorts in the market were trying to bust Jazzo down, but Jazzo quickly recovered. And whenever you see a stock go down through the bottom of a trend line and then start an impulsive move up where it breaks out, this is called here a false breakdown, which implies that when the stock, after it comes out of the top, that it has considerable room to go higher. So in this example here, we would have wanted to purchase it, let's say, midday yesterday. But again, we're day trading, so we're not going to hold it overnight. Okay, now one thing I want to note here is that stocks, they oftentimes run straight up, or they have these minor pullbacks. Now the pullback is the most conservative approach for entering a position. So one thing that Wyckoff talks about is, great stocks will break out, right, through their channels, but oftentimes, more than likely they will have some sort of pullback. So here's where you want to, depending on your trading style, if you're more of a risk taker, you will want to, of course, buy the breakout. And if you're more of a conservative trader, you're going to want to wait for the pullback to the supply line, right, where folks were selling before, which now will act as the demand line, right? So, which once was your foe is now your friend. So where all the sellers pretty much, were slaughtered here, they now become buyers, because all of these folks that bought in here are now going to provide support to prevent it from going back into the channel. So, again, a more conservative approach with the Wyckoff method is to wait for the pullback before executing a position. All right. Hope this helped. Again, this is the Richard Wyckoff method for drawing trend lines.